Let's talk to Dave Harris. He's the CEO for Invatrust Consultancy. Dave, welcome.
Yeah, morning, Nick.
Right, headline for your piece today, Spring Clean Your Personal Finances. There are only 4 weeks or so to go to the end of the tax year, April the 5th. Most personal tax breaks are one-off use it or lose it variety.
Yes.
Far away with pensions.
Yes, I mean, there's always this panic. You can read the press at the weekend, etc., and there's this panic around this time of year. The first point I'd make is there's no need to have this panic in March every year. You have 12 months to do all of these particular things with your personal finance or your investments. But human beings being human beings, lastminute.com. Yeah, exactly, we leave it. I mean, the first thing that people should look at are their pension contributions. We've had successive governments over the last 20 or so years who seem determined to destroy the pensions industry, which is a pity because we really did have the best pensions industry in the world. But there are still things that you should do. If you're a basic rate taxpayer, effectively the tax relief you get on your contribution equates to a 25% interest payment on that contribution. So if you're putting £800 in, the payment will actually be £1,000 because your pension provider will claim the additional £200 from the taxman. So you've got a £1,000 contribution. If you're a higher rate taxpayer, then that goes up to 40%. So it's an even bigger incentive to actually save via a pension scheme. You can't take the benefits from your pension scheme until you're age 55, unless you're in some sort of madcap employment. You know, professional footballer, I think, can get away with 35, but most of us got to be 55. And there's a limit to the amount that you can actually have in a pension scheme now, and that's currently at £1,030,000. I mean, quite why politicians deem that they should put a limit on the amount that we actually save for the benefit of us so that we're not dependent on the state in the future, I've never actually worked out, but they're a law unto themselves.
Understood.
The second thing people should look at are individual savings accounts, ISAs. Each of us has an ability to put in £20,000 per annum into an ISA, and I would encourage people, whatever saving they're doing, be it cash or equity, stocks and shares, anything of that nature, try to get it under the umbrella of a tax-free wrapper called an individual savings account. Cash ISAs, the interest that you receive on your cash within an ISA is tax-free.
Good.
If you're invested in stocks and shares within the ISA, then any income tax or capital gains tax will also be free within the ISA wrapper.
Great wrapper.
There is a thing called a junior ISA, which means that parents and grandparents can contribute up to £4,200 per annum for their on behalf of their children or grandchildren. And then there's a thing called a lifetime ISA, which is specifically for people in an age group 18 to 39. They can invest up to £4,000 a year into this lifetime ISA, and the government then gives them a top-up up to £5,000.
Okay.
The original £4,000 is part of their £20,000 contribution on a normal ISA. Now, you can't get at this money until you're 60, unless you're using the money to make a first-time purchase of a property, or the more unfortunate stage, you're terminally ill. People should remember their straightforward bank deposits. Now, we can all have up to £1,000 per annum free of tax interest on normal deposits. If you're a high rate taxpayer, then that's limited to £500. Inheritance tax, once again, government, taxman, etc., won't leave you alone even when you're dead. If you've got an estate valued in excess of 300, and I think it's this year it's £375,000, but that could change on Wednesday at Philip Hammond's spring statement. You can give away as much money as you like each year, And provided you live for a further 7 years, then it will be as though it never existed in your estate.
So if I was worth 10 million quid, as long as I don't die within 7 years...
you could give it all away, and there will be no tax payable at your death. If you should die within that 7-year period, then there is a pro rata rate. So effectively, it makes sense if you can afford it. And I mean, I do accept that we're sat here sort of talking figures such as that, but most people need most of their money to live on. So they may not be in a position to do so. But if you can, then do it. There is a specific inheritance tax allowance each year of £3,000, which you can give, and that's immediately tax-free and falls outside of your estate. And you can make any number of £250 donee payments throughout the year. If you're doing those 250 ones, one little point I would say, do just pen a letter to who you're giving the £250 to, so that there is a record that when you die that you've actually done it, and it will sit outside your estate.
Okay, capital gains tax.
Yep. If you own stocks and shares and you make a profit on those stocks and shares, then potentially you have to pay tax on that profit. There is an annual capital gains tax exemption of £11,200. So to give you an example, if you bought shares...
Is it 11.2 or 11.7?
11.7, sorry. Give you an example. If you'd bought shares for £10,000, then it makes sense, perhaps, from a tax perspective, to sell those shares before the 5th of April. Let's say they're worth £20,000 now. That would be outside, or within, rather, the 11,700 limit that the government has set.
Sell them, take the money tax-free, then repurchase.
Well, you can then repurchase. The only thing you have to be careful of is that there are rules regarding the time limits on repurchase. So you can't do what we used to do. It used to be called bed and breakfast. You'd sell it one afternoon, you buy it back the next morning. There has to be a 3-month period. Now, there are ways and means around that. So, for instance, you could sell it and your spouse could buy it back. You could sell it, you could repurchase it in your ISA or your pension scheme. If you're going to do things like that, my advice would be just have a chat with your financial advisor, because they are slightly complicated.
Understood.
Other little things you might want to consider, charitable donations that are made under gift aid. Remember that the charity can claim basic rate tax on your behalf, so it boosts the contribution that you make to the charity. If you're a higher rate taxpayer, you can also claim higher rate tax relief through your income tax return. There are other things like enterprise investment schemes and venture capital trusts, which effectively are investing into new companies, IPOs, etc. There are tax breaks going in. They are riskier than your ordinary stocks and shares investments. So my advice would be talk to your financial advisor before you go ahead with any of those. But going back to my original point, do please remember that there are 12 months in the year, and this doesn't have to be done in March every year. You could do it whenever you liked.
On that note, Dave, thank you very much indeed.